Well, good afternoon, as it is here in Sydney, and good morning in other places in the world. Welcome to our webinar, 10 Tech Disasters That Kill Deals and the 10-Day Plan to Catch Them. Today we'll be discussing 10 key technical red flags for private equity firms to consider when conducting due diligence for an investment. These are rooted in practical application of running and managing technology to support and create business value. I'm Andrew Mitchell, a founding partner at MNA Due Diligence Solutions. I have 30 plus years in technology and business transformation across private equity, acquisitions and enterprise contexts. MNA Due Diligence Solutions uncovers technology risks and improves technology outcomes for our clients to enhance and accelerate their deal value. The webinar is for private equity and venture capital investors, anyone doing an acquisition, portfolio companies preparing to grow, or anyone preparing for an exit. A little housekeeping before we proceed. We are recording this webinar and we'll make the recording available to you after the session. We also have a checklist which accompanies the red flags that we're discussing today. And we'll have a Q&A at the end of the session, and we'll take your questions then when we turn the microphones on. So why now particularly? Well, technology is a critical asset to achieve growth objectives. A 6-month delay or a 6-month schedule improvement can impact returns by tens of millions of dollars, either below or above target. One missed pre-investment issue can cost millions to rectify later. One red flag raised at due diligence showed that a target company's applications were very poorly architected and outdated, meaning it would be very time-consuming and costly to integrate into a service vertical that was being assembled along with other acquisitions. By identifying the flag early, the investment committee was able to understand the implications and then move swiftly toward other available acquisition options and avoid millions in rework costs and significant delays to the business plan that they would have otherwise have been exposed to. So as technology continues to evolve quickly and technology spend is increasing, it continues to impact the achievement of growth strategies and objectives. So today you'll leave with 10 technology traps that we are seeing that can kill a deal, and also how you can identify them. We'll summarize 3 immediate checks that you can perform this week, and we'll give you a 10-point checklist that aligns to the discussion. We sent a link to this earlier, but if you need it again, please do drop checklist into the chat later on and we'll get that to you. As mentioned, we'll open up for questions later in the session. And the traps we discuss today are not intended to be exhaustive, but they do provide particular important areas for scrutiny that provide insight. It is important to note that the technology context is broader than just hardware and applications when future growth objectives are being considered. So into the red flags then. We have grouped them into a series of groups, and we'll start with technology strategy related flags first. The first one here, outpost, is where technology is not aligned to a business plan. A technology function that's out of step with the business intent is unlikely to support growth. And this typically only becomes evident after the pressure to scale emerges. So you'd expect to see a documented technology strategy which aligns to and supports the key business processes and goals. And it should also be updated as business plans adapt over time. If this isn't evident to you, then it's fair to expect some difficulty in achieving a new growth target post-investment. Stuck throttle is a situation where the delivery pace is set at one speed and lags business expectations. This can provide insights into the delivery capability of technology and also into the relationship between senior management and the technology function, both which will impact technology's ability to deliver growth expectations. So both these traps provide headline indicators of looming constraints to growth. You might choose to look at the technology strategy together with the business strategy, or talk to senior management about their experience with technology meeting their business needs, and then dig in a little deeper to the answers that provides you. Shifting toward how the technology is assembled, particularly around team now, the superhero red flag typically indicates an assumed rather than intentional clustering of critical functions to one or a small handful of individuals. This is different to a senior key man risk, and it's characterized by an operational choke point. And it's not uncommon with smaller technology teams to see this occur. These situations can challenge maintaining steady state operations and also scale ambitions when process and knowledge is not easily accessed or reproduced. So asking who in technology could you not do without? In a couple of different contexts, and you'll soon triangulate if there is a potential concern to look at further. High stakes homelessness is when there's a pervading lack of accountability and decision making, particularly on critical issues. Poor decisions in the past limit future operations, and unclear ownership now reduces performance. There may also be a need to overhaul the governance approach to meet future objectives. So if we're considering security as an example, asking who owns cybersecurity and do they have a plan that you understand is a great place to start. A set and forget approach to managing important supplier contracts can lead to reduced performance, and service can also be out of step with the current business requirements. Again, this will impact the ability to make change going forward and to scale rapidly. And it also means you are potentially overpaying for the services that you're receiving. So if you were to ask, how did you establish the key relationships with suppliers and how do you keep them on target with business needs, you can spot a blind spot and potentially a capability gap. And it's worth remembering here that most larger technology providers are a little more adept at striking favourable deals than their customer counterparts in the first place. When we consider the more tangible applications and infrastructure aspect of technology, loose coding is a measure of rigour, and rigour influences resilience, robustness, and readiness to change. And the concept applies to both applications and the infrastructure side alike. So focusing on applications for a moment, we'd expect to see systematic and thorough processes from develop and test to implement and maintain. Seeking out the approach to developing and enhancing the core business applications will tell you a lot. It should be documented and it should be visible to you. If there is any uncertainty, then ongoing maintenance gets unpredictable and change for scale becomes harder and slower. Feature focus appears when the applications team is more interested in adding features than optimizing the environment for efficiency and cost effectiveness. There's always going to be a need for more features. However, if quality and cost are a distant second, then achieving a return on investment and being able to scale becomes questionable. So in an investment situation, You might ask, given unlimited resources, what would you change post-investment? And what are you going to turn the dial on? Asking that sort of a question can reveal a lot about the general disposition and where the focus is and where there might be another blind spot. And then considering the general approach taken to technology shines a light on the governance maturity and also on sound management. So the wait and see flag goes up when there's an uncertainty about how new capabilities are adopted, such as responding to AI or cybersecurity in our current world, and it indicates a slower ability to adapt. If an investment thesis includes new customers and regions, products and volume, then this is definitely a flag to look out for, as it will hamper speed and decision quality. Listening to the response to a question like, how did you adopt AI into the organisation? What were the considerations? It will tell you a lot about how these matters are considered and acted upon within the technology function. The unlocked door potentially indicates an insensitivity toward locking down key policies such as security, and may point to a risk posture that is weaker overall. So if this situation exists, then the general risk position is likely to be higher than anticipated, and the work to integrate changes for stability or scale will be greater moving forward. You can test this by asking, how did you make the decision about how to implement two-factor authentication, and what data to protect and how? Who's responsible? Digging into the decision-making a little bit reveals a lot about the management approach to important issues in technology. And the one-way street flag signifies a lack of appropriate continuity plans and resources to return to steady state in the event of an outage. This is not only a concern for steady state operations, but also because untested flaws in the systems will not have emerged yet, and potentially the broader lack of awareness for business critical applications and processes is not there. So how do you respond to a major outage or continuity event? What's the plan? How did the last test go? Questions along those lines will provide some insight into the status and also into the approach taken by the team. So we've quickly talked through 10 technology traps by reviewing red flags that we see. And it's clear that the impacts to ongoing stability and scaling for growth come from more factors than just the hardware and the applications themselves. The broader context around technology needs to be considered. Before we move to a practical method to conduct technology due diligence assessment, there's 3 simple checks that you can perform this week. Firstly, does the technology strategy align to the business strategy and measure return on investment for new initiatives? You're looking for a tight connection and to be able to measure the impact of the money that you are spending moving forward to be satisfied on this one. Secondly, has emerging technology been taken up in a deliberate and timely fashion? This is a great leading indicator of adaptability and of the management approach which are critical to achieving your investment goals. And then thirdly, is the technology, so the applications and the infrastructure itself, deployed in a systematic and modular approach to improve efficiency and lift performance? So is it like Lego, easy to change and connect, or is it more like spaghetti, intertwined and tangled? The due diligence approach that we use is the ICT intelligence system, and it is It is driven to create a clear understanding of the likely impact of technology on the investment thesis. The first step in the risk radar assessment is to uncover the key technology red flags and their impact, and to look out for value-enhancing opportunities. So this step begins to identify red flags similar to the ones that we've just discussed. It incorporates key structure, strategy, team, management, and process elements with a sensitivity to the context. For example, a manufacturing company is different to an online business-to-business company, and that needs to be taken into account in what to look for. This step quickly isolates critical uncertainties and risk items across the technology domains, incorporating automated tools, documentation, interviews, and checklists. It creates the initial list of red flags, like the ones we discussed, plus others, as there are many more, and then isolates the areas for deeper review. The value creation blueprint is the second step, and this is where it begins to calibrate the impact of those red flags. Here we applied deep operational experience to interpret the impacts of the risks and the uncertainties and understand the underlying causes and issues. It interprets the potential impacts to the investment objectives, and it ultimately builds a picture of the landscape and the relevant constraints and how they relate to each other. What are the patterns? What is going on here? The commercial translation engine then drives us back to putting this into a usable, understandable, investment-friendly format. It needs to relate to the investment context, be technically correct, and practically useful. So it drives out the former information and aligns it in a plain English format, and the observations it produces are investment committee focused. So the risks and constraints are related to the investment thesis and quantified for immediate and longer term impacts in a readily usable form and language. And finally, the competitive intelligence layer, which is the final step in the system, it considers what good would really look like in terms of industry standards and frameworks for this particular context, to ensure that it's going to be competitive in that landscape, and then set out how the constraints influence ongoing steady operations and the ability to scale the business as desired in the investment thesis. It considers what order to approach the items and when to do it, so it delivers a complete picture of risk, opportunities, impact, and then when and where you might turn the dial. So that brings us to a couple of case snapshots now. And the case snapshots both apply some red flags that we identified, and these ones saved some particularly significant problems with the acquisitions that were under due diligence at that time. The first here is a situation concerning funding for an expansion into Asia for a financial institution. The due diligence was being conducted on the technology implications, and the investment proposal included replacement of the support management tools, a multi-million-dollar initiative in its own right, because the support performance was known to be very low. So a bit of a red flag sitting there by itself. The review showed up several red flags, including a lack of strategic alignment concerning the tool, so outpost, and long-term poorly managed tweaking of the system, feature focus. The support function, which looked after customer and internal users, was badly underperforming. It was well under industry norms. and that was despite the tool being an industry-leading tool. So closer scrutiny revealed that the underlying configuration made it extremely difficult for the support agents to be efficient and effectively close out the support issues for both the customers and the internal users. And the review highlighted a pathway to a relatively simple correction, meaning that the system did not need to be replaced. Not only in this instance was millions of dollars saved by not needing to replace the system, but the deployment time was also saved in the plan, which could accelerate the achievement of the expansion financial plan overall. So there were two major wins in that situation. Our second case snapshot concerns an acquisition of a transport services company in a private equity context. So the strategy here included a regional expansion and a signing of several new high-volume customers. The brief for the technology due diligence was to establish comfort around maintaining current operations, ensuring scalability, and generating a clear risk profile. Several important flags surfaced during the process, including centralization of knowledge and function in a single individual, superhero flag, particularly for support in this case, which had obscured the true state of the application stability and understated the amount of unmanaged issues, both of which would have obstructed the intended growth plans. There was also a lack of alignment between management plans and the technology capability, which would dramatically slow the intended implementation of a new ERP system. The capability to do this was poorly estimated and overstated. Once these factors were well understood and were considered in the investment proposal, and particularly in the subsequent planning, the unexpected costs and delays that would have occurred down the track were avoided, and the inevitable impacts to realizing the investment objectives that would otherwise have been incurred were not now incurred. So some simple planning was put in place to avoid the impending disasters there of higher cost and losing money due to a 6 to 12 month delay. We have some time for some Q&A now. We'll turn on the mics and we'll open the chat and Q&A. So if you do have some questions, please feel free to pop them in. We have had a couple pop up here. If you're thinking of a couple, I might just answer the couple that have popped in. So first question is, you have discussed 10 flags which are broader than just the hardware or applications. Why is that? That's an important point. The tangible technology, the hardware and applications or software and the network all have to be examined for their constraints. However, the other factors like the strategic alignment, the ability to adapt, the management, are all about how that tangible technology has come about how it is what it is. And so it tells you a lot about how things will evolve in the future. And you need to understand both the impacts from the tangible side as well as those other factors to be truly comfortable. And these how factors about how the technology came about is generally going to rely on operational insights. Ali, do we have some other questions there?
Yes, I have a second question here related to cybersecurity. When doing due diligence on a firm from the outside, what topics do you look at, or what areas do you look at in terms of looking at the security postures?
Okay, so with security, there's a couple of ways to review that, and it does depend a little bit on the context of the target. If the target is a firm that perhaps is a services or a manufacturing firm, you'll look at that differently to if the target is a business-to-business online application type firm, where a large platform is the interaction point with customers and various other points of data. So in both cases, you want to be sure that there is some form of security policy, and you want to be sure that the policy is complete in what it's covering for the context, and you want to ensure that whatever the controls are actually in place. There have been cases where someone making an acquisition has also gone as far as to do some penetration testing when it's been a highly exposed business-to-business type application. So there's various different levels, and it needs to be in the context of the type of the organization and the type of the applications and touch points there are. However, some of the underlying areas, multi-factor authentication, there's various other areas that come up once you understand the context and the controls that should be there. I hope that answers the question.
Yep, I've got a second one here. How has due diligence changed now with the introduction of AI in many companies, adding on sort of ad hoc AI to their businesses?
Wow, we could do a whole webinar on that one, I reckon. But in brief terms, AI has opened up a lot more questions, and I think I mentioned it in one or two of the red flags. There is a question about how an organization thinks about it and adopts it. It necessarily opens up an exposure for their data if individuals are able to put confidential documentation into a public AI machine and say, summarize this for me, then that confidential information is suddenly public. So there needs to be an internal set of controls and processes around that. And then there's also about information coming in and attribution rights about how that information that is acquired through AI is either the truth or not, or is available to be used or not. So again, we're back to controls a bit there. And then finally, AI offers many, many different sorts of advantages in many business process situations. So understanding how advanced or not an organization is in picking these up, what sort of a plan it's got, what sort of competitive advantage that's giving it or not, is also another aspect of it. And typically an organization will have some sort of AI adoption plan. And there's some very clear factors that you'd look to form a view about whether it's appropriate, whether it's well thought out, and whether or not they're actually proceeding with that, and does it match what the business growth plans are. So a number of different layers there. And yes, it is interesting. And from our side of due diligence, absolutely using AI power to do some of the process work in the background is important. But at the same time, we still rely on a lot of deep operational operator insight as well. AI isn't at the point where it can just do it all for us, interestingly, but there are some very good tools there that can be applied.
Okay, great. There's a third question that came in about looking at the investment thesis. So how would you treat a bolt-on versus a carve-out when you're looking at it from the outside?
a bolt-on versus a carve-out.
So when you're going in to do a due diligence from the outside, and the investment thesis is quite varied, how would you look at how would the due diligence vary from doing a bolt-on versus, say, a carve-out, or if the investment thesis is different?
So the fundamentals of technology are relatively similar across the board. So the principles about what makes technology work are fairly similar across the board, and they will vary for the context of the organization. So as we mentioned before, the due diligence needs to take that into account. Now, where something is a bolt-on with a very specific integration goal, potentially into a larger technology environment, then the ability to get it there quickly is very important. The ability to have data working really well is important. The ability to report on being able to do that from a management reporting aspect is really important in future. When it's just a separate organization that's being acquired as a standalone situation, then it's really more about how does the technology serve the overall business purpose that becomes important. And if it's a carve out, it's very much about being able to identify the status of the technology and why it's appropriate for that carved out entity that's going to be moving on, and acknowledge any gaps and what are the plans around those gaps.
Okay, great. That's it from my screen.
Right, there was another one I saw pop across here. The last step in the 4-step model looked at frameworks and industry standards. Shouldn't that be the first step? Great question. So looking at the maturity of a technology organization and what is important to ensure that it's fit for purpose in that context is very important. However, we find often in due diligence, particularly in technology due diligence, that the investor wants to know the big red lights and sirens, the big red flags, really early if there's going to be a showstopper. So that's why we are generally targeting what are the big red flags early, what's going to really make a difference or hurt, and then move toward broader view on the technology itself and the technology environment about what does good look like and where it can go. So I hope that answers that question. Does anyone have anything else they wanted to ask at this point? Okay, so moving on then, what's next? If you need the red flag checklist, please just drop checklist into the chat and we can send that to you. If you'd like to have a 15-minute chat about a specific case that you have, or a specific acquisition or specific situation, we're happy to do that. And we'd be quite keen to follow that up. So also just either pop into the chat or you can email us. Can we book a 15-minute brief? And we will absolutely get that to you. Otherwise, I think that concludes if there's no more questions. So I thank you all for joining. I do hope that the information's been useful to you, that there's 10 flags that you know a bit more about now, 10 big traps that can cause disasters, and also 3 items that you can go straight back and ask this week to get a better feel for those technology areas in your either acquisition targets or portfolio companies. And if you need more information, please do reach out. Thanks very much.